Hi, I'm Bill Blain, strategist here at Shard Capital, still working from home but looking to return to London very soon. Now, summers in the markets are typically very slow times, but this year's kind of different. Markets continue to anticipate recovery and they're being buoyed by ultra low interest rates and they're hitting successive highs. Many market observers think it's all too much. Markets are overvalued and due a correction. Let's wait and see what happens after the summer. But the first thing that caught my ear this morning was a very earnest young economist from some bank in the city commenting on the 13.4% annualised rise in UK housing prices. He was asked to explain why, during the worst economic shock in over 300 years, that's the pandemic in case anyone's forgotten about it, house prices were on the up. He then went into behavioural analysis about couples reassessing their work-life balance, deciding to upsize, moving out to the conurbations on the outskirts of town, and looking for better schools and a better life in the country. It's absolute twaddle. Famously, economists will never agree on anything. Put three of us in a box and you can expect four different theories on the economics of box economies. Suffice to say, I disagree with the young economist. The reason UK house prices have risen is largely a matter of distortions. Over the last 12 months, we've had the stamp duty holiday, but longer term, it's the absurdly low level of interest rates, which is a massively distorting monetary phenomenon that has been a massive factor driving the asset inflation that lies at the core of rising UK housing stock. Sure, there is an element of the self-satisfied middle classes and company directors deciding to monetize their rising pension pots, their stock portfolios which have grown, and also improving bonuses which maybe were increased by the success of stock buyback programs. Now, all these gains in stocks are the consequence of low interest rates creating financial asset inflation. It's encouraged these fortunate holders of financial assets to scale up, and that explains why it's currently taking about 7.3 microseconds to sell any home in Rock, the Cornish town that everyone wants to live in. Upper-end homes are a good example of how financial asset inflation has migrated into the real economy, but it only affects a very small number of people. For everyone else, there is brutal reality. First up, it's an absolutely ridiculous notion to think that the UK population could all collectively decide to upscale their housing simultaneously. Remember, here in the UK, we are famously short on housing stock. Each band of the supply is limited. It's famously a ladder. To find the right home requires that home to be on sale and simultaneously be able to sell your current home. If the middle classes all collectively decided to move to a new house with one more bedroom and a better view, it would just not be possible. And that then leads to the second question of who is going to step in and buy your house as people want to climb up the property ladder. Well, the reality is that UK property has not been this unaffordable for over 140 years. The average UK house price is now £245,432. Now, if you had a 5% deposit, roughly £12,500, that would require you to have a £60,000 a year salary and then to be able to find a 4 times multiple mortgage. Now, that is possible if you are two people together and doing fairly well, but the average UK salary is only £38,600. That's the average salary. The medium salary, the medium earnings, are only £30,000, meaning that even the average UK house is at least double the price most people in the country can realistically afford. At 8 times earnings, the UK home market is at its most unaffordable level since the 1880s. Now, that sheer unaffordability sounds absolutely shocking, and why doesn't the market correct that? But in fact, home ownership is comparatively recent in the UK. It was given prominence in the 1980s by the Thatcherite privatisation of public-owned rental stock, council homes. In fact, I would go as far as to be heretical here and suggest that the blessed Margaret Thatcher is a person as responsible as anyone else for the global financial crisis from 2007, which I reckon will continue, after she encouraged everyone to load up on mortgage debt to buy their own homes. Previously, we'd been a nation of renters. Today, private sector renters now outnumber council social renters. Of course, most people who own a house quickly build up significant equity embedded in their current home, especially when prices rise at 13% per annum. Now, the total value of housing stock in the UK is round about £7.6 trillion. Total outstanding UK residential mortgages are only around £1.5 trillion. That means there's a notional £6 trillion of housing equity. Now, historical data, and we have plenty of data on housing prices in the UK, shows that if there is a correction in UK housing stock, which we have seen many times, the price correction is usually quickly reversed, usually within 24 months. That means that that £6 trillion of equity means that UK houses literally are safe as houses, supported by a massive demand for UK housing from the people who are climbing that ladder I was talking about and those trying to climb onto it. But there are also other buyers as well. The UK has always been a place where people want to own property from abroad. They look to buy assets in what they perceive to be a politically stable UK. We may have our problems, but we are more stable than most countries. And you also have people who are buying homes as financial assets, seeking to rent them out to generate returns. So the reality is, UK housing has proved a pretty safe asset class. But despite the 13% gains this year, over the long term, equity markets typically outperform the housing market. Personally, I don't actually own any rental property. I've always found it too difficult, the returns are low, and it tends to generate tax questions. But what I do is invest in property companies as part of my general portfolio. However, that's a digression. Let's go back to my original comment that UK housing stock and prices have been distorted by low interest rates, government distortions like the stamp duty holiday, and other factors. Let's not ascribe all the rises in house prices to this social nonsense about couples around the country deciding to go and find nicer schools for their children to be brought up in. Let's look at the reality of when interest rates are as artificially low as they are today. When interest rates make money effectively free, you'd be mad not to abuse that to acquire assets on leverage. That's the main factor that has driven stock markets to continually make record levels over the last 10 years. If you take a look at stock markets, they're in a pretty much upward sloping curve like that. Now, the same thing is happening in mortgages because ultra low interest rates encourage investors to go out to borrow to invest, expecting to see house prices perform in exactly the same way as financial assets, and that linkage is definitely working. So ultra low bond yields, ultra low interest rates are encouraging investors to take more risks in other markets, including mortgages. Now, that's a very significant change in the way that people have come to regard it. You're not just buying a home, you're buying an investment. Yeah, sure, we've been talking about how much our homes have gone up in value for years, but ultra-low mortgage rates, where they're available, encourage home buyers to over-leverage. That's always been a factor. Now, this is where the behavioural science does come in. When a convenient excuse, like the pandemic has generated, occurs, that has the effect of reinforcing what people want to believe. That's when it's suddenly become much easier to persuade home buyers that they can take on more debt to leverage up their houses by buying something bigger. Think about it. What's not to favour buying a bigger home when the devil is whispering in your ear? You're going to be working at home for years. You may as well have a decent office. Interest rates are going to remain low forever. The central banks all say so. Oh, you don't need to worry about your job in the city. The pandemic's not going to affect you. Oh, the kids will love it if you move to a new school in the country. That's the kind of thing that people are seeing in the press, they're reading, they're seeing in all these shows about housing, and that's why there's a housing boom going on. People are convinced that they can go out and borrow and get something better. It's just a variation on the theme that I often expose about markets. The housing market is no different to any other market. It has but one objective: to inflict the maximum amount of pain on the maximum number of participants. So, if you've just moved to the country in search of the good life, you should maybe be fearful. This time next year, you could well find yourself catching the least reliable 2-hour train service in the world to London each day, while your partner hates you because they have to drive the kids to school every day because the local council doesn't have the money to subsidise buses. And you may then find that that dream beautiful house you bought in the country is being eaten by woodworm, and you can't fix it because a newt was spotted in the dried up pond 12 years ago. And that may not even be the worst case scenario. UK housing is a funny old market, but get ready for the reality. Thanks very much for your attention. There'll be another Porridge Lite-Bite soon.